when you most want your gold, when the panic hits and everyone like, get me out of stocks, get me out of money market funds, I want gold, you're actually not going to be able to get it. You're not going to be able to get the gold. The dealers won't talk to you if they don't already know you. The mint will be back ordered. The dealers will be back ordered. You will not be able to get people on the phone. So why wait for that? Do it now while you can.
Today we have with us one of the most educated minds on the global financial system and the monetary system. We're going to talk about where we've been, where we are, and where we're headed, and how that impacts you and what you can do to protect yourself. Coming up. I'm Lynette Zang, Chief Market Analyst here at ITM Trading, a full-service physical precious metals dealer specializing in gold and silver and really specializing in strategies to help you survive and thrive through the reset that we've already entered. So welcome to Coffee with Lynette. I can't even begin to tell you how excited I am to have our very special guest today, Mr. Jim Rickards, who, quite frankly, I've been a huge fan of his work and learned so much from him over the years. His education is impeccable. His experience on the inside and his truth-telling on the outside for everybody else is really so grateful for all of it. There are a couple of key experiences that he's had that I'd like to talk a little bit more about. One, as you know, I talk a lot about long-term capital management and derivatives. Well, he was there as lead counsel, and we're going to talk a lot more about that in just a minute. In addition, he was the advisor to, or he is the advisor to the Department of Defense, and he was the facilitator of the first ever financial war games that was conducted by the Pentagon. And quite honestly, he said that China won because they bought a lot of gold. So aside from that, he is a speaker, he is an educator, and he is a best-selling author of a number of books. But what he's also done in his current book called Aftermath, it concludes the International Monetary Quartet that started with currency wars, then the death of money, the road to ruin, and now Aftermath, which will be released coming up on July 23rd. So with all of that, Jim, thank you for being here today.
Thank you, Lynette. It's great to be with you, and thank you for that very kind introduction.
Well, you're very welcome. But I usually like to start with what really motivates you to do the work that you do, because I know it's a lot.
Well, I spent most of my career, over 40 years, as a lawyer, but I was always a lawyer in-house, not at law firms, but inside institutions, and they were all financial institutions of one kind or another. I worked for 10 years at Citibank. I was their global tax counsel. I worked for 10 years at a firm today. It's part of National Westminster, but when I was there, it was called Greenwich Capital. But it was one of the largest dealers in U.S. government bonds and government securities. So that's when I got immersed in government finance. I was start to finish at the hedge fund long-term capital management. I was their general counsel. Glad to say not the risk manager, but sort of the legal risk manager. But I did negotiate that bailout with what I call the 14 families, the 14 big Wall Street banks and the Federal Reserve in 1998 around a stock exchange. So my whole career I've been in finance. So yeah, a lawyer, but a lawyer in financial institutions and really a problem solver. And that's what motivates me when I see things either that are difficult to understand. If I can solve them, I can help others learn about them. Or probably more important, certainly in my recent work, I don't consider myself doing predictions. It's more warnings. The signs are there. If you know how to analyze them correctly, you can see problems coming. And I just like to let people know what they are. They can make their own decisions as to Whether they want to get ahead of it or ignore it or whatever, that's up to the individual. But I try to warn people about what's coming so they can be prepared. I always use the phrase, we're not helpless. Maybe we don't have the power or the leverage to change the outcome, but we do have degrees of freedom to position ourselves and survive the outcome. And that's what I try to talk about in my books.
And you do a really good job with this. This is kind of, I have a tendency to mark up my books. It's really good reading. So I recommend the entire series to anybody that wants to really understand this. But it does start with the foundation, which is money, which is what we work for. Can you explain a little bit for our viewers what is money and why it really matters to them to understand this?
Well, I'd be glad to, but you raised an interesting question. Well, everyone thinks they know what money is. They look in their wallet and they got some dollar bills or $20 bills or whatever, and they say, "Oh, I got some money right here." Well, you call it money, but when I went to law school, the first thing I learned early in contract law was read the contract. So the paper money in your wallet or purse is a contract between you and the Federal Reserve. Well, read it. Along the top, it says Federal Reserve Note. It doesn't say money. It says Federal Reserve Note. Well, where I went to law school, a note is a liability. In other words, it's a form of debt. And that's what it is. If you look on the balance sheet of the Federal Reserve, it's publicly available. You can find it on their website. What most people call money is listed on the liability side. So I look at a dollar bill and say, well, it's money, sure, but it's also a perpetual non-interest bearing liability of an insolvent bank. So that sort of gets your mind around that. And even the Federal Reserve, you ask them what money is. Well, they have, M for money, they have M0, M1, M2, M3. They all have different definitions. So which one is it? So even the Fed doesn't know what money is because they've got 4 different definitions of what money is. So just to kind of cut to the chase, money, the classic definition of money, it's a medium of exchange. So you can use it to buy and sell things. It's a store of value. So if you have it, it's worth something and can be, utilized later. And it's a unit of account. It's a way to measure things and count things. The unit of account is probably less important. You can do that with baseball cards or bottle caps. And yeah, money's good for that, but so are a lot of other things. But the store of value and the medium of exchange are really important. And throughout history, feathers, shells, beads, gold and silver, credit cards, debit cards, they've all been different forms of money. Today we have cryptocurrencies. I'm not a big fan of cryptocurrencies. I don't recommend them, but they can be used as money. So people say, well, they're not backed by anything. The dollar's not backed by anything, or Bitcoin's not backed by anything, et cetera. Well, the truth is they're all backed by one thing, which is confidence. If I'm going to give you something and you have confidence that it has value, and furthermore, you have confidence that you can give it to someone else and they'll accept it, then that's money. So the key to money, it has that 3-part definition, particularly store of value and medium of exchange. But what makes it money is confidence. But the problem is confidence is fragile. It's very easily lost and impossible to regain. So it's true that something can be money one day and not be money the next day if individuals lose confidence in it. And this is the debate I always have with the Federal Reserve and also these what they call modern monetary theory, MMT. Mm-hmm. I know I've met most of the top practitioners or supporters of that. Professor Stephanie Kelton of Stony Brook, State University of New York, Paul McCauley, formerly of PIMCO, and others, Warren Mosler and others. I met a lot of them and had kind of one-on-one debates. And the one thing they don't get is the fact that confidence can be lost, because they say, well, what's the problem? You can print, the Treasury can borrow unlimited amounts of money subject to the debt ceiling, which gets raised. And then if the bond market has a problem, the Fed can buy the bonds, monetize the debt, put it on the balance sheet and hold it for 30 years and get paid at maturity. So what's the problem? That's a tough argument to refute. It used to be that when progressives in particular, but any political faction said, well, we got to spend more money on, a Green New Deal or free healthcare or free tuition or free childcare, whatever it may be, you could answer that by saying, well, yeah, but we can't afford it. As we can't afford to run those kind of deficits. But today they have an answer. The answer is, yes, we can. There's no limit on the amount of money that the Fed could print or the Treasury can borrow. And ironically, they looked to Ben Bernanke to prove it, because Ben Bernanke did print $4 trillion to prop up JP Morgan and Jamie Dimon's bonus. And so they say, well, if you can print $4 trillion to help Jamie Dimon, why can't you print $4 trillion for the Green New Deal? That's a tough one to answer. Well, here's the answer. It has nothing to do with the debt ceiling or the Fed's balance sheet, because the truth is the Fed can print as much money as they want. There's no legal limit to it. But there is a psychological limit. There's a confidence boundary. And you don't find it until it's too late. You say, well, what's the confidence boundary? Well, it's probably less than $4 trillion because we've been there. But is it $5 trillion, $6 trillion? I don't know exactly where it is, but I do know it exists. And you'll find out the hard way when you hit it. And people say, you know what, I'm done, I'm out of here. Get me out of dollars. I want land, art, gold, silver, natural resources, water, oil, anything except the dollar itself. And so confidence can evaporate almost overnight. So that's the answer to MMT. That's the answer to the big spenders. But they don't get it because you can't quantify it. It's psychological. You can't stick it in some general equilibrium model that the Fed uses. But it's there, and they'll find out the hard way when confidence is lost.
Right. And you want to be properly positioned when that happens, because isn't that what leads us to the hyperinflation?
Correct. Now, it could be hyperinflation. That's one problem.
Or hyperdeflation.
Deflation is the same thing. My friend Harry Dent keeps saying, gold's going to go to $800 an ounce. I know Harry. I don't agree with him. I see it heading to $10,000 an ounce. But what I say to Harry is that look, nothing happens in isolation. If you're right, I don't think it is, but if you're right, that gold goes to 800. Well, Dow's going to be 2,000. In other words, it's not like gold's going to go to 800 and everything else is going to stand still. $800 gold is a major, major deflationary episode in which all other markets are collapsing. So I might like my $800 gold better than my $2,000 on the Dow Jones. So I think gold's going higher. I think inflation will prove to be more of a risk in the long run, but don't underestimate the impact of deflation. But they're both bad.
Absolutely. Well, they're both they're flip sides of the same coin, aren't they, really?
Correct. They come from bad monetary policy. We saw the deflation in the Great Depression. We saw the inflation in the late 70s, but both of them were caused by Fed blunders, and the Fed unfortunately hasn't learned much.
No, they keep doing the same thing, even though it's proven that it's not true. But talking about that, and we're talking about gold and silver, and how do they typically perform through either one, whether it's inflation or deflation?
Well, there's a good track record that shows that gold goes up in both. Now, the inflation's easy, so the dollar's worth less, so the price of oil is going to $200 a barrel, and gasoline is $6 a gallon at the pump, and real estate prices are doubling, and your salary's going up, but you don't seem to be any better off because the price of everything's going up. And in that world, sure, gold will break through 2,000, go to 3,000. I think in the longer run, it'll get to $10,000 an ounce. But interestingly, the longest sustained deflation in U.S. history during the Great Depression from 1939 to 1934, gold went up 75%. In other words, gold went from about $20 an ounce to $35 an ounce. In dollars, that's a 75% increase. So there's a case where gold actually went up in deflation, and we know it goes up in inflation. So you could say that gold always wins. By the way, the reason gold went up in 75% in the Great Depression was the government made it go up, because the government of President Roosevelt and before that Herbert Hoover, they didn't know how to end the deflation. They didn't know how to do it. But FDR had one economic advisor said, look, just devalue the dollar against gold will go up and everything else will go up with it. That's exactly what happened. I mean, in the midst of the Great Depression, 1933 was one of the best years ever for the stock market. Well, that was when FDR devalued the dollar. So saying there's a higher dollar price for gold is just another way of saying you're devaluing the dollar. So gold is a constant store of value. It wins in inflation and deflation, and history shows that.
Well, you made a point in one of the videos that I was watching that the Fed can cause 150% inflation in 15 minutes. Could you
Right.
talk a little bit more about that?
Sure. The Fed's been trying to get more inflation for 10 years. The Fed says they want inflation at 2%. They wouldn't mind it at 2.5, 3, but they say 2 because it sounds better. I don't know why 0 is not the right number, but they're targeting 2%. It's kind of a sad day when the central bank wants inflation and can't get it. They've only hit that 2% level once in the last 7 years, and recently it's going down again. It's gone from 2% to 1.9, 1.8. Today it's around 1.6. So the Fed is failing completely to get the deflation they want, let alone something more than the inflation.
Mm-hmm.
Thank you. They're failing to get the inflation that they want. But what they could do, remember, there's 8,000 tons of gold in West Point and Fort Knox, and the Fed has a printing press, so they could go in, take a vote, walk outside 15 minutes later, and Jay Powell could stand up in front of a microphone and say, my fellow Americans, as of now, as of today, the price of gold is, say, $5,000 an ounce. And we stand ready. If you think that's cheap, we'll sell it to you all you want. We'll deliver it from Fort Knox. And if you think it's expensive, you sell it to us. And the Fed can kind of stand there, and with a $5,000 price target, they can be, a buyer at 49.75 and a seller at 50.25, and if they do that, the price of gold is $5,000 an ounce because they say so, and they've got the dollars and the gold to back it up. In effect, it's an open market operation. It's no different than what they do with bonds. When the Fed wants to increase the money supply, they buy bonds. Well, if you want to increase the price of gold, go buy some gold. They can do that. So my point is, they can do that almost instantaneously. Well, if they do, it's not, again, going back to what I said before, it affects everything. Nothing else stays the same. So the world of $5,000 gold is the world of, $100 silver, $200, maybe $400 oil, et cetera. Everything would go up, and you could cause the inflation. They don't want to do that because they don't want to acknowledge gold as a monetary asset. They don't want to pay any attention to gold. But if you get desperate enough and you get stuck enough, you can do it. And that is what FDR did in 1933. He solved the deflation problem by raising the price of gold.
Isn't that also, in essence, resetting the value of the paper money, of the fiat money, the government money?
Yeah, I try to explain to people. People say, well, Jim, I hear you say gold will be $10,000 an ounce, and I expect it will be, and I can't wait till it goes to $10,000 an ounce because I'll make all this money. And I say, well, be careful what you wish for. Nominally, yes. If you bought your gold at $1,400 and it goes to $10,000, you'll make a lot of money, but bear in mind that the money won't be worth that much more because everything else will be inflating. Now, at least you'll preserve value. Everyone else will be wiped out, and you will preserve wealth. And gold is very, very good for that. But don't start counting your profits, because when you look around, housing is going to go up 5 times, and gas is going to go up 5 times. It'll be like the 1970s. You have to have lived through the late 1970s. People like to say, the value of the dollar has gone down 95% since the Fed was created in 1913. And that's true, but salaries have gone up and incomes have gone up. So the economists like to say, well, yeah, the dollar went down, but your salary went up, and so it's all good. That's phony, by the way, because those numbers I just recited, they're averages, but the averages are not evenly distributed. The rich do a lot better than the middle class. But anyway, getting back to that decline in the value of the dollar since 1913. Well, you don't have to go back to 1913. The 5-year window from 1977 to 1981, those 5 years inclusive, the dollar declined more than 50%, not over 100 years, but in 5 years. That's what inflation looks like, and that was borderline hyperinflation. I lived through that. I lived through the period when gold went from $35 an ounce to $800 an ounce. And I worked in Midtown Manhattan at Citibank, and we actually had a lunch hour in those days, and I'd go out for lunch or maybe go shopping at Bloomingdale's. And in the late 70s, you couldn't walk up Lexington Avenue without seeing a chain snatching. I mean, somebody would grab a gold chain off a woman, she'd scream, and the guy would be running around the corner. But you saw it every day. That's how crazy the gold situation was. And it doesn't take that much to get there. And the way the Fed's going, we'll probably get there again.
Yeah, because it really does boil down to that confidence piece. The gold at 10,000 or even at a trillion, I mean, who knows where it's really going to go in terms of dollars or euros or yen, but it really is about value. Gold
Right.
holds its value. And that also creates some opportunity. But, I'd like to kind of go back just for a second because you were talking about the discussions, and I know that you had a discussion with Tim Geithner
Right.
about the SDR, and I'd like to talk a little bit more. Can you explain that scenario and then what that would look like, or what it
Sure.
could
And
look
I
like?
should make it clear, Lynette, that the book Aftermath will certainly discuss gold. I'm not going to write a 300-page book and not talk about gold, but it covers a lot of other things as well. It
Yes, it
covers
does.
some work I did with the CIA and the Russian acquisition of U.S. uranium assets. That's been publicized quite a bit, and there have been other books written about it. But I had a front row seat on that because I was asked by the CIA to create a panel of private advisors to work with the government on foreign takeovers of U.S. companies, which I did. I recruited, hedge fund people, Wall Street lawyers, risk arbitrageurs, subject matter experts, think tank people. We put a group together. We called it the Dirty Dozen. But we worked for years inside the intelligence community to look at foreign acquisitions of U.S. companies. But curiously, that the Russian takeover of U.S. uranium assets was not shown to us, and it should have been. We were created for that purpose, to look at controversial deals. But clearly, I say, Secretary of State Hillary Clinton, who was on the committee that approved it, and General Clapper, at the time the Director of National Intelligence, they worked around us and then ultimately disbanded our group. But that was partly that was occurring at the same time as this uranium deal. So I talk about that. I was actually targeted for recruitment by a couple of Russian spies, so over drinks at the Fontainebleau Hotel in Miami. So I talk about that. Of course, I contacted counterintelligence and alerted them to these people immediately. So hopefully they got what was coming to them. But my point being, there's a lot else in the book, but specifically with regard to Tim Geithner, I had a private one-on-one conversation with him in Manhattan, and I had worked up a thesis, which I think is valid, that in 1998, Wall Street bailed out the hedge fund, long-term capital management, and I negotiated that deal. In 2008, central banks bailed out Wall Street. Bear Stearns failed, Fannie Mae failed, Freddie Mac failed, Lehman failed. Morgan Stanley was days away from failing. Goldman would have been next, then Citi, et cetera. Well, the Fed bailed out the Wall Street. Well, the next crisis, and it's coming sooner than later, who's going to bail out the central banks? All they do, they keep moving the problem upstairs, from hedge funds to Wall Street to central banks. Who's going to bail out the central bank? Well, the only clean balance sheet left is the IMF. And Geithner was president of the Federal Reserve Bank of New York, secretary of the Treasury, but he also worked at the IMF on occasion. So I asked him, I said, I think the Fed's at the limit of what they can do. They printed their way out of the last one. I'm not sure they could print their way out of the next crisis because they've never cleaned up their balance sheet. And the IMF could issue, say, 1 trillion SDRs that would be worth about $1.5 trillion and hand them out to the members. It's just world money. It's a world printing press and world money. Now under the control of an American, by the way, David Lipton, since Christine Lagarde has left to become new head of the ECB. I said, do you expect that to happen? And he said no. He said that we tried it in 2009, which was true. They issued some SDRs at the end of 2009. And he said it was very clunky. It didn't work the way we expected. And I said, well, then how will you solve the problem? And he told me, and I put that in the book in chapter 6. I'll leave it to the readers, but it's a very interesting answer. I don't agree with the answer. There was more to the dialogue. Geithner said it, and I put it in chapter 6 of my book, which that's the chapter on the global monetary reset. So it's in there. Subsequent to that conversation, which took place in New York, I spent an hour in Hong Kong. Well, I was there for a few days, but spent an hour one-on-one with the former head of the IMF. And I asked him about Geithner's critique of the IMF and of SDRs, and he nice guy, but he just blew up. He said that guy he hates the IMF, and so I got an inside the IMF perspective on how SDRs work. And a lot of this stuff I knew from my own studies, my own research. But as you said earlier, Lynette, it's one thing to read it, study it, and understand it, which I do. It's another thing to talk to Geithner. I spoke one-on-one with Ben Bernanke in Korea. I spoke one-on-one with the head of the IMF in Hong Kong. So all these insights you get from speaking to the actual leaders, the actual policy makers, they're invaluable. You don't get that on TV or newspapers or websites or whatever. And I put all that in the book in chapter 6. The title of that chapter, by the way, is the Mar-a-Lago Accord. I mean, what better place for a new Bretton Woods? If you think of it, President Trump as a convener could call the heads of the major economies of the world together, get together Mar-a-Lago, and do something like Bretton Woods. I think that should happen. I don't think it will happen. That would be too rational a way to do it. It's more likely that we'll have another panic, and everything we're talking about will be done under panic conditions in a very hurried way. But it would be great if they could do it sort of proactively while there's still time.
Well, you also brought up something really recently about the SDR being pegged to gold since, interesting date, October 1st of 2016.
Right.
Could you explain a little bit more about that, please?
Sure. And this was called to my attention by an analyst in Switzerland named D.H. Blair. He sent me an unsolicited bit of research, and I looked at it and I said, well, this can't be true. And I duplicated the research. I got the data myself and looked at it, and it was true. And what he was showing me was that, and we should explain the significance of October 1st, 2016.
Absolutely.
That was the day that the Chinese yuan was admitted to the SDR basket. That was when the IMF let China into the club, if you will. Now, there's a lot of confusion about what an SDR is. It stands for special drawing right. I call it world money because that's what it is. It can be printed by the IMF anytime they want. They can hand it out to their members. By the way, I'm enough of a geek. I actually read the articles of agreement of the IMF. And in there it says that the IMF can give SDRs not only to members, but other multilateral institutions if they feel like it. That could include the World Bank and the United Nations. So you could see the IMF printing world money, giving it to the UN for climate change. I mean, that's how kind of out of control that is. But anyway, just assume they give it to the member countries. Well, what is an SDR? How do you value it? Well, there's a formula, and there were 5 currencies behind it. Sorry, there were 4 currencies behind it. U.S. dollar, yeah, you expect that, euro, pound sterling, and Japanese yen. And they were the only 4. Well, now they've added a 5th, which is the Chinese yuan, which is a big deal. By the way, China didn't qualify. Using the IMF, they didn't qualify, but this was a political decision. Well, what the research shows, prior to October 1st, 2016, the dollar price of gold and the SDR price of gold were highly correlated. They were volatile. They were going up or down, but they were going up or down together. You would sort of expect that because the major component of the SDR is the dollar. But beginning October 1st, 2016, the dollar price of gold continued to fluctuate, but the SDR price of gold started to flatline, and it stayed in a very narrow trading range. And without having, concrete proof, because you'll never know what's going on inside the Communist Party of China, certainly from the data, it appeared that the dollar price of gold was, going wherever it wanted to go as a free market with some manipulation. But the SDR price of gold had been pegged, centered at 900 SDRs per ounce. And, it would go to 925, and then it would go back down to 875, and then up to 910, and back down to 890. It fluctuated, but it stayed in a narrow trading range and no longer correlated to the dollar price of gold. Well, just on the face of it, that looks like somebody's pegging gold to the SDR. Well, that's a big order. There aren't too many institutions in the world that can do it. I think the only ones would be the United States government, the European Central Bank, the IMF, and China. No one else has the clout to do that. Well, we can eliminate the U.S. and the European Central Bank because they're actually transparent. I mean, they tell you what their gold holdings are, and if they were buying and selling gold to maintain the peg, you'd see it, and you don't. That's not there in the data. Could it be the IMF? Possibly, but again, they have trouble getting consensus on what kind of soda to put in the refrigerator, let alone pegging the price of gold. But China could do it. They're non-transparent. They have the resources. So from the outside, it looks like we may already be on a gold standard and not even know it. But it's not a dollar standard. It's an SDR standard, and it's being implemented by China. But I also, again, this is all in Chapter 6 of my book, Aftermath. But I talk about other possible, people use the word reset, the monetary reset. Well, that's okay, but they don't really say what a reset is or what it means. There have been several over the past 100 years, most famously Bretton Woods in 1944, but that wasn't the only one. But there are a lot of ways to do it. You can have a pure gold standard of the kind we saw from 1870 to 1914, or you can have a modified gold standard with the dollar stuck in the middle, which is what Bretton Woods was, or you could have something like this SDR peg. But I also explain how you can have a gold standard. Countries, I think, other than the U.S. could have a gold standard without having much gold. All you have to do, you peg your currency to gold by weight, and then when people want to redeem it, they say, well, give me the gold. And what you say is, well, I'll give you dollars, but it'll be dollars calculated in such a way that you can buy the amount of gold we promise you. And you could work with something like the Shanghai Gold Exchange for what's called straight-through processing. So you're basically using all the gold in the world that's available to markets, and that would be quite a bit of gold, to back up your gold peg, even though you would briefly intermediate through the dollar using, as I say, something like the Shanghai Gold Exchange. And interestingly, I have a good relationship with Prime Minister Mahathir of Malaysia. I was out to Malaysia a few years ago. I was honored to celebrate his 90th birthday party at a small private dinner in Kuala Lumpur, and we talked about this. And of course, he's been interested in it for 30 years, so he's not a newcomer. But I sent him an early draft of Chapter 6 with this particular section I call the Malaysia Plan. It's sort of in his honor. He recently gave a speech in Hong Kong where he called for something exactly along the lines I described. He said South Asian countries can have their own gold standard, even though they may not have that much gold. So there are a lot of ways this can go. I think what's important is not that we go back to the 1870s, although we could, but even if it's a more modern form of gold standard or just using gold as a reference point, all of them point in the same direction, which is much higher gold prices, because that's the only way to reconcile physical gold with the money supply.
Well, and that's also a way to get that confidence back, the public confidence. Because I think once people are beaten up and bloodied and bruised, that's when all the confidence is gone.
Right. You could have a sequence of events where you do have something like modern monetary theory. By the way, I mentioned Professor Stephanie Kelton. She's the big brain on MMT. She's also the chief economic advisor to the Bernie Sanders 2020 campaign. Now, we'll see how Senator Sanders does. I'm not sure he'll be president, but if he is, you can bet that you'll see Stephanie Kelton at the Treasury or the OMB or the Fed or someplace very important. So don't discount this as, crackpot theories. There are smart people behind it, and they've got some political muscle. But you might see a situation where something like MMT comes to the fore, it gets traction. We do double the debt to GDP ratio from now 106% to over 200%. Then the confidence is lost. Then you have to go back to the gold standard to restore confidence. So it's not a straight line. It doesn't happen overnight, but it's all within our powers, our ability to see it coming. And that's really what I talk about in my book, Aftermath. The warning signs are all over the place. You just have to understand them, incorporate them, connect the dots, and then see how it plays out. And it's not just one path, or multiple paths, but they all sort of end up in the same place. And then I bring it full circle. I say, well, if this is coming, and it is, what are you waiting for? Why not get ready now? When I've had people say, I'll be half facetious, but it's kind of true. They say, Jim, I hear you, I agree with you, but I'm making too much money in the stock market. Could you call me at 3 o'clock the day before the crash, and I'll sell my stocks and buy some gold. And I said, well, first of all, I'm not going to know the day. I can tell you it's coming, but I don't know the day. And I might, if I did, I'd probably be a little busy myself. But the point is, when you most want your gold, when the panic hits and everyone like, get me out of stocks, get me out of money market funds, I want gold, you're actually not going to be able to get it. You're not going to be able to get the gold. The dealers won't talk to you if they don't already know you. The mint will be back ordered. The dealers will be back ordered. You will not be able to get people on the phone. So why wait for that? Do it now while you can.
Exactly. I remember what happened in 2008 when the spot was dropping and still we were flooded and the premiums were exploding, and we were one of the few dealers that could actually get stuff even though it was back ordered. At least we could because of our relationships. So I think this will probably be more like that on steroids.
I think that's right. This is what I talked about in my last book, The Road to Ruin. But in aftermath, I say, well, gee, Jim, if you covered all that ground, why did you write a fourth book? And the answer is just to round out the story. The fourth book actually looks through the next panic. Instead of warning about the panic, which I've done and continue to do, this says, what does the aftermath look like? What does it look like after the panic? How do we live? What has value? What things can you do beforehand to prepare for it? That's a little more of the theme of this book, and that, as I say, wraps up the International Monetary Quartet. But I hope people find that very useful. And again, a lot of good stories along the way.
Yes, absolutely. I want to go back to long-term capital management and the derivatives. Because in my opinion, that's probably the biggest threat is the loss of liquidity in that market. So, but most people don't understand derivatives, and you do fantastic metaphors. So I'm going to hand this over to you and see if you can just go into that a little bit more, because that was the first derivative implosion that threatened the global financial system.
Sure. Well, just to take a really simple example, let's say that there was, the bar of gold in front of us, and I wanted to sell it to you, you wanted to buy it. We would go back and forth over the price. We'd agree on a price, and we'd sell that bar. But what if we had one bar of gold, and just make up, let's say a 1 ounce gold coin, so $1,400. And I said, okay, Lynette, I could sell you the 1 ounce gold coin for $1,400, but why don't I sell you 100 ounces? I only have 1 ounce sitting here, but we'll make the other 99 a paper contract, and we'll agree that either I pay you or you pay me, depending on where the price goes from here. So bear in mind, we only have 1 ounce of physical gold, but we do a deal on 100 ounces, 99 ounces of paper gold and 1 ounce of physical gold. Well, that's a much bigger deal, a lot more money involved, a lot more profit and loss for either one of us. But there's still only 1 ounce of gold. The other 99 is the derivative. So a derivative is just a paper bet. It's a paper bet based on some underlying with no limit as to how big the paper bet can be. Now, I'll give you another concrete example. And I remember in 2007 when the mortgage crisis first hit in the spring, and then there was a money market crisis in August, and that's when Jim Cramer had his famous meltdown with Aaron Burnett on CNBC. They know nothing, but the point being, that was the beginning, and then it came to a head over a year later with Lehman Brothers in September 2018. But when it first started, there were some very smart people, and I would put, Ben Stein and others. He's an economist, and he's a comedian, actor, but also an economist. And a lot of other people said, look, there are $1 trillion of subprime mortgages, and that's about what there was with Alt-A. That's another kind of subprime, but let's say $1 trillion of subprime mortgages. In the mortgage market, 5% is a huge default rate. When default rates get to 5%, people are kind of panicking. He said, let's get crazy. Let's assume a 20% default rate. It never got that high, but just assume it. Well, 20% of 1 trillion is 200 billion. So he said, even if this thing gets totally out of control, we'll have 200 billion in losses, which was about the same in real terms as the S&L crisis in the 1980s. That was about 135 billion of losses. So adjusted for inflation, it would be $200 billion by 2007. And Stein said, well, we survived the 1980s. We can survive this. It's about the same. What he was missing was that, yeah, there were $1 trillion of mortgages, but there were $6 trillion of derivatives on the mortgages, on the same mortgages. And so 20% default rate, it wasn't 200 billion, it was 1.2 trillion of losses just to get started. And then the panic went on from there, and the losses were ultimately in the scores of trillions.
Right.
But the point being, you cannot look at bank balance sheets. You cannot look at futures contracts. You cannot look at any known quantity and understand the risk without understanding how much is off balance sheet, how much more of the same thing, the same kind of bet. And banks do not put derivatives on their balance sheet. And I've had this debate in chapter 8 of the book, chapter 8 of Aftermath. I talk about a private briefing that I had with the board of directors of Morgan Stanley and their CEO, James Gorman. And it was very pleasant. We were out in California, and I was an evening speaker at a board meeting. It was just me and a relatively small group. The board's small; it's about 12 people, and a few senior officers. And we debated this. And Gorman and Colin Kelleher, who's his right-hand man, tough guy. They were pushing back on me. They say, well, Jim, you don't understand. Morgan Stanley's more solid than it's ever been. Our capital base is higher. Our liquidity is better. The Volcker rule keeps us out of certain proprietary bets, on and on. And our derivatives are lower than they were. So we're a rock-solid bank, much stronger than we used to be. And what are you talking about? And I said, well, first of all, a couple things. Number one, your derivative book might be smaller. It actually was, but that's because so many of the derivatives were moved over to the clearinghouses. They created these clearinghouses after 2008. So now, two banks do a derivative trade, and they take it and they send it to the clearinghouse, and you put it on the balance sheet of the clearinghouse. You didn't make the risk go away. You just moved it to a side pocket. So, yeah, maybe Morgan Stanley or Citibank's balance sheet has fewer derivatives, but it doesn't mean there are fewer derivatives in the system. They've just been put over in the clearinghouse. Who's going to guarantee the clearinghouse? Again, Morgan Stanley's capital base may be fine, at least in most circumstances, but who's backing up the clearinghouse? Well, the answer is the members, which are the banks. So if the clearinghouse gets in distress, they're going to turn to their members and say, hey, give us capital, at a time when the banks are like, oh, we can't do that because we need all the capital we can get. So first of all, you're undercounting derivatives when you ignore the clearinghouses, number one. Number two, and this was the point I made, I said, look, as a bank, you may be stronger, but you're part of a system, and the system is more vulnerable. And if the system goes down, you go down with it. I don't care how strong your balance sheet is. You're part of something bigger, and if that collapses, you collapse too. And I said, look, you're running a bank. You can't take responsibility for the whole world. That, in theory, is the responsibility of regulators and central bankers and others. But they don't know any more about risk than Wall Street does. I mean, everyone's ignoring the risks or not computing the risk properly. So I say, yeah, maybe your bank's more sound, but you're not counting the clearinghouse, and you're ignoring systemic risk, which is bigger and more dangerous than ever.
Right. It is, because there's, you were talking earlier about people selling their stocks and their money markets and all of these and buying gold before the crisis hits. But will there be any buyers on the other side of any of these assets?
Well, that's right. And this is what I talk. That's correct. Now, this is what I talk about in chapter 4 of the book, how more and more assets under management have moved to passive investment styles.
Yes.
That means index funds and ETFs and things like that. Well, when passive investing started, when it began, I analogize it to like a mosquito lands on the back of an elephant. Well, the mosquito has a good time and the elephant doesn't even notice. So passive index funds were basically piggybacking on active investors who were committing capital, taking risk, and making markets, engaging in price discovery, and you could just kind of go along for the ride. But what happens when it's not one mosquito, it's a billion mosquitoes? The answer is the elephant dies. And that's what's happening in markets. More and more funds are going passive. Fewer and fewer are going active. Well, the active investors are the ones who commit capital and make markets. So you get into a financial panic with the passive investors. Their investors want their money back, so they have to sell stocks or sell assets or sell bonds to get money to pay the redemptions. Well, where are the buyers?
Exactly.
you've driven the active managers out of business. They're not going to be heroes like firemen rushing to a fire. They're going to walk away, and so the market's going to go no bid, and it's going to go straight down. That's again, I talked about that in chapter 4 of my book, and it's one of many. I talk about MMT. I talk about debt and deficits. I talk about passive investing. I talk about how behavioral psychologists manipulate people's decisions through something called choice architecture. Sounds geeky, but it's just good old-fashioned behavioral manipulation. I talk about the systemic scale, and then I finish in the conclusion with a little thank you to Lionel Shriver. Lionel's an award-winning novelist who wrote a book a couple of years ago called The Mandibles. It's fiction, it's a novel, and she very kindly mentioned me and Currency Wars at the beginning of her book. And then part of the book is modeled on some scenarios that I wrote about in Currency Wars, although, it's all her original work. Great novel, by the way. I highly recommend it. So I kind of returned the favor by talking about her book at the end of Aftermath. And she, people like to put words in your mouth, and they say, well, Jim Rickards says, the world's coming to an end, sell everything, buy gold. I've never said that. The world's not coming to an end. I don't recommend selling everything. Yeah, have some gold, but I'm happy. I think 10% is a good allocation. But here's the point. The world may not come to an end. I don't think it will, but it can change. And the world after the next financial panic could look very different from the world we're in today. And Lionel Shriver paints a very good picture of it. I do the same at the end of my book. And I think that's valuable to readers because it'll get you ready for what's coming.
Yeah. Well, some people think that cryptocurrencies is going to be the answer. Could you talk about how you feel about cryptocurrencies? And of course, they always make it look like it's gold or silver.
Yeah, it's interesting. The graphical images are always gold coins. Tells you something about what they're thinking. And again, they talk about mining Bitcoin. Well, it's just computer algorithms, but they like the mining metaphor. Yeah, I'm not a big fan of cryptos. I don't. Look, there are over 2,000 cryptocurrencies on the exchanges, so you can't lump them all together. You have to really study them. You have to look at, what are their governance features? What are their issuance features? Are they sustainable? Are they scalable? Most of them are not sustainable, not scalable. Bitcoin is a dead end. Now, I'm not a big fan of cryptos. Now, look, for betting purposes, if you want to make a bet, and so there's a winner and a loser. It's a zero-sum game, but there's no value added. There are Bitcoin millionaires and Bitcoin billionaires. I know people who have made millions of dollars in Bitcoin, but all they did was take it out of the pockets of the losing side of the bet. There was no wealth creation. There was nothing added to society. There was no value added. It's just a medium for one person to take money out of another person's pocket. If that's the way you want to make money, be my guest. I don't find it particularly attractive. It does facilitate criminality, tax evasion, terrorism, drug dealing, and worse. So not a big fan of cryptos. And I think you're seeing that with Facebook's announcement of the Libra. Everyone got very excited about it, but the pushback's been pretty strong. Jay Powell said, and you guys got a long way to go. And you think about what Libra is. You give Facebook $1, they give you some amount of Libra. It is what's called a stable coin. It's pegged in terms of a dollar price. So you give Facebook $1 or $1 million, whatever. They give you some Libra. They take that money and put it in liquid assets, treasury notes, bank deposits, CDs, money market instruments, cash equivalents, etc. You get the Libra. How much interest do you get on the Libra? Zero. What happens to the interest they collect? They keep it. There's a name for that. It's called banking. So good luck, Facebook, but you're going to need a banking license to be in that business. At best, it looks like a money market fund, which is heavily regulated in the U.S. At worst, it looks like a bank. You need a banking license. So I don't think Libra is going very far. Not a big fan of cryptos. If you want, you don't have to buy fake gold coins. Get some real ones, and put them in a safe place. So Lynette, it's been great talking to you. I really, really appreciate this opportunity, and I hope your viewers and listeners enjoy it.
Oh, I think this has been fabulous. Is there anything else, and we didn't even really get to even a fraction of the questions. I could talk to you all day. But is there anything else that the biggest message that you want people to know about what what's going on in the economy and where we're headed?
Yeah, I would say the biggest message, and this is really why I wrote the book, is that there are a lot of danger signs on the horizon. I go through them one by one, chapter by chapter, but I make the point that we're not helpless. There are things we can do. You have to see the danger first. You can't solve a problem unless you know what the problem is. So hopefully I do a good job of explaining the problem,
You
but I
do a very
also,
good job.
thank you, have recommendations as to what you can do. The book, you'll find it in bookstores on the shelves July 23rd, but it's available for pre-order today on Amazon, Barnes & Noble, Powell's,
And
other
your site,
uh,
the
but the James Rickards Project,
right,
yeah,
I
that'll
have the
link you
links.
through. That'll link you through to a place to buy it. But so you can pre-order it now, and if you pre-order, you'll get your book on the publication date. So everyone else will be getting it the day after or whenever. So you'll be the first readers, and I hope people enjoy it.
Well, I know that I did, and thank you so much. This has been great. We'll have to figure out what we're going to do. Maybe I'll get you to come back again so we can ask more of these questions.
Great. Look forward to it.
And everybody, you've got all the links so you can access Jim's website and his Twitter. And thank you so much. I hope everybody enjoyed it.
Thank you.
Okay, and remember that your financial shield is made of physical gold and silver, not paper or contracts or promises. So until next we meet, please be safe out there. Bye-bye.